Welcome to the Way of Wealth. I'm Corey.
And I'm Lily. Corey. Last episode we covered Macleod's views on silver, where he gave a $300 target. This episode we're continuing with his gold analysis, but I noticed something really interesting. He doesn't give a dollar target for gold at all.
Good observation, Lily. And that's actually the most thought-provoking starting point for today's episode. Macleod doesn't give a gold price target not because he has no views on gold, but because in his analytical framework, measuring gold in dollars is itself a fundamental error. This position creates an interesting contrast with his $300 silver target. Silver is an industrial metal plus monetary asset, so you can still use a fiat currency framework to calculate it. But gold, in his view, has transcended that framework. It is the foundation of that framework.
Measuring gold in dollars is wrong? That's really intriguing, because that's how we look at markets every day.
Let's start with his first core argument, which he calls the Gold Pricing Thesis. Macleod says that in human monetary history, gold has never been the object being measured. It is the measuring stick for everything else. You shouldn't ask how many dollars gold is worth. You should ask how much gold $1 is worth. He says gold has been humanity's universally recognized ultimate settlement tool since Roman times. Every real monetary crisis in history has ultimately ended with gold re-establishing order. Fiat currency is just an interlude in that process.
That completely inverts the way we normally look at markets.
He has a powerful historical case study that we mentioned last episode, the German stock market in 1921. Measured in gold, the market dropped over 90%. But measured in the depreciating mark at the time, it only dropped a quarter. Those German stock investors thought they'd only lost a quarter of their wealth, but they didn't realize the measuring unit itself was rapidly disintegrating. So, on the surface, gold has climbed from over $1,000 all the way to its historical high of $5,597. But in Macleod's framework, this isn't gold appreciating, it's the dollar depreciating, and the depreciation is accelerating. He says mainstream media reporting gold prices in dollars every day is like Germans in 1923 tracking assets in marks every day, without realizing the measuring unit itself was collapsing.
So we're watching gold's dollar price every day, but we're actually using a constantly shrinking ruler to measure a metal that doesn't change.
Your analogy is very accurate, Lily. This also explains why he doesn't give a dollar target for gold. Giving one would be meaningless, because the ruler itself is variable. He says asking how high gold can go in dollars is like asking Germans in 1921 how high the stock market could go in marks. You're asking the wrong question.
So what does Macleod think is the most important gold question to focus on right now?
His answer is, don't ask where gold is going in price, ask where gold is flowing. This is his second core thesis, and one he's been repeatedly emphasizing in his recent published articles, the Gold Eastward Flow Thesis. In his latest article from April 24th, he wrote that Asians, especially Chinese, are gradually draining all the deliverable physical gold from the United States, leaving behind an empty shell like an abandoned beehive.
That's a striking image. Is there data to support this?
Yes, and it's first-hand market data. COMEX, gold open interest, fell from a peak of about 550,000 contracts on January 22nd to roughly 400,000 contracts by March 20th, down nearly 30%, the lowest level since 2018. At the same time, American mine production is continuously flowing to Swiss refineries, where it's refined into gold bars meeting Chinese delivery standards, then shipped to Shanghai. Swiss gold exports to China increased 18% in March compared to February. Macleod says this conveyor belt is accelerating, but Western investors are almost completely unaware.
What does the collapse in COMEX open interest represent?
It means the paper financial participants trading on COMEX are exiting in large numbers, but the physical gold isn't staying behind. It continues flowing east. COMEX is gradually transitioning from a physically backed exchange to an empty paper settlement platform. Macleod says while Western traders are still discussing technical levels, whether gold is overbought, when it will pull back, Eastern buyers don't care about any of that. They only care about getting the physical metal in hand.
Corey, these numbers make me wonder something. If Western traders keep exiting COMEX while physical gold keeps flowing east, how much longer can COMEX's paper gold system hold up?
Macleod doesn't give a specific timeline for that question, but he says once the market realizes the paper gold counterparties can't deliver physical, price discovery will happen instantaneously, And the price at that instant definitely won't be the number currently displayed on COMEX. He has one observation worth remembering. COMEX open interest has never been neutral market data. It reflects how many people are willing to use paper contracts as substitutes for physical holdings. When that number collapses while physical gold continues flowing east, the intersection of those two lines is what Macleod calls the trigger point for gold repricing.
That makes me picture a warehouse with a sign saying Gold Exchange. But inside, the shelves are increasingly empty, with only labels explaining how much gold used to be there.
Macleod's analogy is more direct. He says COMEX is left as an empty shell, like an abandoned beehive. The structure is still there, but the honey was moved out long ago. He says this removal process didn't happen suddenly, but has been proceeding slowly but continuously over recent years. Only most Western investors haven't noticed. In his article, he also points out a very specific gold transport route. Gold from US mines flows to Swiss refineries, gets refined into 1 kilogram bars, meeting Chinese standards, then ships from Zurich to Shanghai. This conveyor belt, Macleod says, is currently operating at increasing speed. And what most Western investors are focused on is still where today's technical support is, where the next resistance level is.
Corey, what's his judgment on where this trend ultimately leads?
That brings us to his third core thesis, the gold final settlement thesis. Macleod says, in the entire financial system, gold is the only asset with absolutely no counterparty risk. If you hold a gold bar, it doesn't depend on any institution, any government, any contract being fulfilled. Fiat currency? He says, fiat currency is essentially a deferred payment. It promises you can exchange it for something real in the future, but that promise is built on confidence. Once confidence collapses, the promise goes to zero.
So central banks frantically buying gold isn't just because they think the price will rise, but because it's the only true settlement tool.
That's exactly how Macleod interprets it. He says central banks hold gold not to earn returns, but because in any form of credit crisis, gold is the only tool that can complete settlement without any third-party intervention. The dollar, euro, yen all need a counterparty to recognize their value. Gold doesn't. He says Asian central banks, governments, and private investors are absorbing gold simultaneously at 3 levels, but Western investors still have extremely low gold allocations in their portfolios. This asymmetric situation, he believes, will eventually recalibrate in a violent manner.
Corey, did he discuss how long this Gold Eastward Flow trend can continue? In his view, is there any force that could reverse this direction?
Macleod's answer to that question is very direct. He thinks this trend is almost impossible to reverse unless the West rebuilds a currency system backed by physical assets. He says Eastern buyers' motivation for purchasing gold is fundamental distrust of the fiat system, and the root cause of that distrust, government's ability to print money infinitely, hasn't changed. As long as that root cause remains, capital will continue seeking an exit, and gold is the final exit. He also mentions that current Middle East conflicts and global geopolitical uncertainty have further accelerated this trend, making more and more Asian governments and investors realize that holding dollar-denominated assets carries risks that are no longer just exchange rate risk, but more fundamental sovereignty risk.
Corey, I have a question here. Macleod says to ask, where is gold flowing, rather than where is it going in price? That framework is very enlightening. But for ordinary listeners, what's the practical significance of this observation? Does it affect our decisions now?
His point is that in this process of massive gold eastward migration, physical gold supply in Western markets is getting tighter and tighter, not paper supply, but the kind where you actually want to get your hands on a gold bar. He says when this tension accumulates to a certain level, any trigger event could make physical gold extremely difficult to purchase at normal prices in the short term, because sellers know you can't get it elsewhere, so premiums can expand infinitely. For ordinary people, holding physical while supply is still relatively normal is the only way to avoid this risk.
Corey, did he discuss the bigger macro framework, gold's relationship with the entire global monetary system?
Absolutely. And that's exactly the starting point for his fourth thesis. Also, the most macro level. He says, we're witnessing a historic transition. The world is moving from a system backed by financial assets to one backed by physical commodities. For the past several decades, Global credit has been built on US treasuries, stocks, derivatives, these financial assets. But when the credibility of these financial assets comes into question, capital flows back to things that have intrinsic physical value: gold, silver, energy, food. He says this transition doesn't happen overnight. It's a slow gravitational pull. But once it reaches a critical point, the speed becomes nonlinear. He cites an observation he uses repeatedly. In the past 100 years of monetary history, every attempt to move away from metallic currency has ultimately ended in some form of crisis, then returned to arrangements closer to a metal standard. 1971 was the furthest departure so far, and therefore, he believes this correction may also be the most dramatic in history.
So he's not just talking about a gold bull market, but the underlying logic of the entire monetary system changing. Corey, this makes me wonder, if we really enter a commodity-backed system, what would be the position of existing assets like stocks, real estate, and bonds in that new framework?
Macleod's answer to that question is an extension of his credit bubble thesis. He says, stocks, bonds, real estate, the value of these assets in the current system is all built on credit expansion and people's confidence in the fiat system. Once the system switches, the value of these assets measured in gold could contract very dramatically, just like the German stock market in 1921, which dropped 95% measured in gold. He says, what can truly preserve value through this transition are assets with intrinsic physical value, and gold and silver are the two with the best liquidity and most universal acceptance.
Corey, these four theses together, the pricing thesis, Eastward Flow Thesis, settlement thesis, and commodity repricing thesis, are actually describing four different facets of the same thing. Gold is slowly but certainly returning to its original position in thousands of years of human history, from an asset that's been ignored and marginalized in the modern financial system.
He says this is exactly why gold's rise is far more than a signal of an investment opportunity. It's a warning signal that the dollar system is heading toward its endpoint at accelerating speed. Wealth measured in fiat currency is ultimately just a number. Gold has been humanity's tool for final settlement, for confirming the reality of wealth, for thousands of years. Today, that tool is rapidly flowing from west to east.
Corey, I want to tie together Macleod's four theses from today: the Gold Pricing Thesis, Gold Eastward Flow Thesis, Gold Final Settlement Thesis, and Commodity Repricing Thesis. These four together give me a very strong impression. He's not just describing a short-term gold bull market, but civilization's entire method of measuring wealth undergoing a deep-level switch.
You've captured it perfectly, Lily. That's exactly the core we're trying to convey in this entire episode. Macleod's own words are, "This is the end of one era and the beginning of another." He's worked in finance for over 50 years and has seen many cycles, but he says this time is different. This isn't a cycle, it's a structural change. Just like the end of the gold standard in 1971 was a structural change, except that time went in one direction, and this time is the reverse. He says, when this kind of historic transition truly begins to accelerate, it usually doesn't give ordinary people much time to react.
So the practical meaning of this complete set of views Macleod shared today for every ordinary person is, don't just watch how much gold's dollar price rose today, but think about how much you actually hold that's truly tangible, truly yours.
That's exactly the conclusion he keeps emphasizing, and the core this show has always been about. The question isn't how many dollars gold is worth, but whether you've actually gotten your hands on it. Today's content represents his views. Listeners can go directly to Macleod Finance Substack to read his more complete arguments, which include extensive historical data and chart support. If you can't touch it, you don't really own it. Bye.
Bye.